Chapter 21, Stocks, Bonds, and Mutual Funds. In this video, we'll be discussing stocks. We'll learn how to read, calculate, and explain stock quotations, as well as calculate dividends of preferred and common stocks and calculate return on investments. First, we need to discuss some basic stock terms. Companies sell shares of ownership in their company to raise money to finance operations, plan expansion, and so on. These shares of ownership are called stocks. The buyers of stock are called stockholders, and they receive stock certificates verifying the number of shares of stock they own. There are two basic types of stock. The first is common stock. Common stockholders have voting rights within the company. The second is preferred stock. Preferred stockholders do not have voting rights, but they have preference over stockholders when it comes to the payment of dividends. Cumulative preferred stock entitles owners to a specific amount of dividends in a year. Should a company fail to pay dividends, dividends in arrears occur. A dividend is a payment to shareholders from the profit of a company. So say a company earns a $100,000 profit and they decide to pay out dividends. The dividends would first be paid to the preferred stockholders. Then if there's any money left, it would go to the common stockholders. If it is cumulative preferred stock, those stockholders are entitled to dividends every year. If a company does not pay out dividends in a specific year, dividends in arrears occur. That means that a company then has to pay dividends for every year it has not paid, including the current year, to catch up those preferred stockholders on their payments that are due. And we'll look at an example of how to look at that. Stockholders elect the board of directors. Now, these are common stockholders because they're the only ones who have the voting rights. So stockholders elect the board of directors, and the board of directors elect the officers of the corporation. So stockholders are the ones who are essentially the true owners of the corporation and have a voice within the corporation. How are stocks traded? Stocks exchanges provide an orderly trading place for stocks. You can think of stock exchanges as an auction place. Only stockbrokers and their representatives are allowed to trade on the floor of an exchange. Stockbrokers are professionals who buy and sell stock, and they charge a commission for this job. This commission is paid to stockbrokers for both the buying and selling of stock for investors. So this is a stock quotation as you might see in a newspaper or running across the ticker at the bottom of a TV on, say, a news channel. And we're going to break this down so that you understand how to read this step by step. In this example, we're looking at AT&T stock. The high, starting at the left, you see it says 52 weeks and it says high and low. The highest price at which AT&T stock traded during the past 52 weeks was $43.48 per share. This means that during the year, someone was willing to pay that much for one share of stock. The lowest price in the last 52 weeks that someone paid for one share of stock was $35.81 per share. The newspaper lists the name of the company, AT&T. The symbol that AT&T uses for trading is the letter T. Next is yield percent, 5.1. The stock yield percent tells stockholders that the dividend per share is returning a rate of 5.1% to investors. This 5.1% is based on the closing price. AT&T has declared a dividend of $1.96. So you're able to calculate this yield percentage. And we'll come back to that. Next is the PE. This is the price earnings ratio. It measures the relationship between the closing price per share of stock and the annual earnings per share. And we'll look at how to calculate that. The last tells you the last price on the last trade day. The closing price was $38.43 per share. So that tells you that the last trade price was $38.43. And on the previous day, the closing price was up 15%, the net 15 cents, the net change here. It tells you that the price is up 15 cents from the previous day. So if the last trade price was $38.43 and it is up 15 cents from the day before, you can calculate that on the previous day, the closing price had to have been $38.28. The $38.43 less the 15 cents increase. So going back to those three calculations that were shown, we're going to break them down and learn how to calculate them. The first was that yield percent. Yield percent is annual dividends per share divided by today's closing price per share, and it has to give you the annual dividends per share. In the example, it tells us that the annual dividends per share is $1.96. Today's closing price was $38.43. We saw that in the ticker here at the last price. So when you divide those out, you get the 5.1% yield number that was shown. Next, earnings per share. Earnings per share is not listed on the stock quote, but you can calculate it by taking annual earnings divided by a total number of shares outstanding. In our example, annual earnings divided by total number of shares outstanding, we get $2.14 earnings per share. We need this to calculate the PE ratio, the price earnings ratio. The price earnings ratio is the closing price per share of stock divided by the annual earnings per share. So our closing price was $38.43 and our annual earnings per share was $2.14. That gives us the PE ratio of 18. If the PE ratio shows ... that means the company had no earnings. So here's an example. Maytag Company earns $4.80 per share. Today's stock is trading at $59.25. The company pays an annual dividend of $1.40. Calculate the price earnings ratio and the yield on the stock. So to calculate the price earnings ratio, we want to take the last price per share of stock and divide it by the annual earnings per share. So our last trading price was $59.25, and it tells us our earnings per share was $4.80. So $59.25 divided by $4.80, Maytag has a PE of 12 because it tells us to round to the nearest whole number. For B, we want to calculate the yield on the stock. The yield is the annual dividend per share divided by today's last price per share. Our annual dividend is given at $1.40, and today's price is $59.25. $1.40 divided by $59.25 is 2.4%, rounded to the nearest 10th percent. If you own stock in a company, the company may pay out dividends. It's important to note that not all companies pay out dividends. That doesn't mean that it's a bad company to invest in. Rather than paying out dividends, the company may reinvest its earnings for expansion, new equipment, things like that. So just because a company doesn't pay out dividends doesn't mean that it's not a good company to invest in. But if it does pay out dividends, then it pays dividends on preferred and common stock. Remember, it pays on preferred first and then common stock. So in this example, the stock records of Jason Corporation show the following. They have preferred stock issued of 20,000 shares. The preferred stock is cumulative at 80 cents per share. That means that the company is entitled, the owner of the preferred stock is entitled to 80 cents per share every single year, whether a dividend is paid or not. They also have common stock issued of 400,000 shares. In 2020, Jason paid no dividends. In 2021, Jason paid $512,000 in dividends. We need to calculate how much of the $512,000 in dividends goes to the preferred stockholders and how much goes to the common stockholders. So our first calculation, we need to see how much in 2020 was owed to the cumulative preferred stockholders but was not paid. We didn't pay anything, but we owe them $16,000 in dividends. The 20,000 shares of preferred stock that have been issued times 80 cents is $16,000. Common stockholders are not owed anything. They don't have a right to a dividend. So we only owe $16,000 in 2020, but it wasn't paid. In 2021, we paid $512,000 in dividends. Well, of that $512,000, we have to first pay $16,000 to our preferred shareholders for 2020. Then we have to pay another $16,000 for 2021. They have to get their dividends in arrears and the current year dividends first. So we have to pay $32,000 in dividends to our preferred stockholders. So the remaining $480,000 goes to our common stockholders. Now, it didn't ask us, but how much is our dividends per share? You would take the 480,000 and divide it by the 400,000 common stock to get $1.20 per share. When we're calculating this, we're only calculating it on the common stock. We're only worried about the true owners. We don't look at the preferred stock. So the 480,000 dividends by the 400,000 common stock to get the $1.20. Return on investment. What if you had bought a different stock than AT&T? What if you had bought General Mills? You bought 200 shares of General Mills stock at $39.09 and then sold them a year later for $41.10. If you had a 1% commission rate buying and selling the stock and a current $1.21 dividend per share in effect, what was your return on investment? So we've got to figure out first, how much did it cost us to purchase the 200 shares? How much did we sell them for? And how much dividends did we earn? And then once we figure all of that, we can calculate our return on investment. So first of all, we bought 200 shares at $39.09. So the shares themselves cost $7,818. But we also paid a 1% commission on the total cost. So 1% commission on the $7,818 is $78.18. So the total cost of the 200 shares is $7,896.18. We then held those for a year and sold them a year later for $41.10. The 200 shares we sold at $41.10, we sold them for $8,220. But we paid a 1% commission on the sale as well. This time we have to subtract $8,220 from our proceeds, because at the end of the day, we only got $8,137.80. We had to pay 1% to our broker. So we had to pay it here, so it costs us more, and then we got less. So our total amount of money we actually received less the amount it actually costs us we actually had a gain of $241.62 on the sale. We sold those 200 shares for $241.62 more than we paid for it. And we earned dividends on them throughout the year. We had 200 shares and they paid $1.21 in dividends. So we got $242 in dividends throughout the year as well. So in total, we earned $483.62 in a gain on our investment. So we can calculate our return on our investment by saying we had a gain of $483.62 over our cost of $7,896.18. Our rate of return is 6.12. Our top is our portion, our base, figuring our rate of return.